Right now, thousands of traders are hitting the sell button on Bitcoin, and most of them have no idea that this exact moment is the one smart money has been waiting for. Before you make any moves, you need to understand what is actually driving this sell-off, because the reason behind it changes everything about what happens next. Let me be direct with you. What you are watching right now is not necessarily Bitcoin breaking down. It might be Bitcoin doing exactly what it has always done before a significant move. The question is not whether you survive this volatility. The question is whether you understand it well enough to come out of it in a better position than you entered. So let us break this down properly. No hype, no fear, just clean analysis. To understand why traders are selling, you have to understand the environment Bitcoin is living inside right now. The macro backdrop has been unusually complex. The Federal Reserve has kept interest rates elevated for longer than many analysts expected, and that has a direct effect on risk assets. When borrowing costs stay high, institutional capital tends to rotate towards safer, yield-bearing instruments. Treasuries become more attractive, risk appetite shrinks, and Bitcoin, which is still classified by most institutional frameworks as a high beta risk asset, feels that pressure acutely. At the same time, liquidity conditions across global markets have tightened. The amount of free capital sloshing around the system looking for returns is smaller than it was during the easy money era of 2020 and 2021. This matters because Bitcoin's most explosive price moves historically coincide with periods of expanding global liquidity. When liquidity contracts, volatility becomes more two-sided, meaning the drops feel sharper and the recoveries feel slower. But here is where it gets interesting. The spot Bitcoin ETFs, which represented a structural shift in how institutional capital accesses Bitcoin, have seen some net outflow days recently. That is not catastrophic, but it matters psychologically. When retail traders see ETF outflow headlines, they interpret it as institutions leaving. Often, that narrative is oversimplified. Large funds rebalance regularly. Outflows on certain days can reflect profit-taking after strong runs rather than fundamental loss of confidence. But retail traders do not usually make that distinction, and so the fear compounds. Now let us talk about the chart, because this is where the story becomes very readable if you know what you are looking for. Bitcoin has a structure that experienced traders respect deeply. Price does not move randomly. It moves between levels of liquidity. Think of liquidity as pools of money sitting just below or above the current price. Below the market, you have clusters of stop-loss orders placed by traders who bought higher. Above the market, you have clusters of sell orders and short positions waiting to be squeezed. These pools are magnets for price. Market makers and large participants know exactly where retail traders place their stops, because retail traders tend to place them at obvious levels, just below round numbers, just below recent lows, just below the previous week's low. When Bitcoin dips aggressively, it is often hunting those stops. It is collecting the liquidity sitting beneath nervous traders, and the traders who place those stops, they become panic sellers. They exit their positions at a loss, and that selling pressure is absorbed by whoever is accumulating on the other side. Currently, Bitcoin has respected a multi-week structure where there are significant demand zones acting as cushions. These are price ranges where, historically, buyers have stepped in with meaningful size. When price enters those zones, the drop tends to slow down, consolidate, and then make a decision. A clean hold of a demand zone, followed by a series of higher lows, is one of the most constructive patterns you can observe. Conversely, a decisive break below a demand zone with high volume and no recovery suggests the structure has shifted and lower prices need to be respected. The key levels to watch right now are the areas where previous price ranges consolidated for multiple days. Extended consolidation at a price level means both buyers and sellers agreed that price was fair in that range. Breaking out of that consolidation with force in either direction is significant. Right now, Bitcoin is sitting at a decision point. The next few daily candle closes will tell us a great deal about which faction is currently in control. Let us talk about what is going on inside the minds of the people selling right now, because trader psychology is not a soft topic. It is one of the most important analytical tools you have. When price drops sharply and quickly, the emotional brain activates. This is not metaphorical. Neuroscience shows that financial losses activate the same neural pathways as physical pain. The instinct is to stop the pain, which means selling. The problem is that by the time most retail traders feel enough pain to sell, the move has already happened. They are selling into the hands of someone who has been waiting for exactly this level. There is also a psychological phenomenon called recency bias. Traders who have watched Bitcoin drop for several days start to believe it will keep dropping indefinitely. They extrapolate the recent trend into the future as if nothing will ever change. This is precisely why bottoms are so hard to identify in real time. At the exact moment the market is about to reverse, sentiment is usually at its most negative. The news cycle is bearish. Social media is full of people calling for further downside, and the traders who hold through that noise or who cautiously accumulate into it are the ones who benefit from the eventual recovery. This is not about being fearless, it is about being calibrated. Good traders are not emotionless. They feel the same uncertainty as everyone else. What separates them is that they have a framework for making decisions under that uncertainty rather than reacting to it. Now let us talk about what institutional participants and smart money might be doing during this period, because their behavior is often the inverse of retail behavior. Large players do not buy in a straight line. They accumulate positions over time, often during periods of elevated fear and low retail participation. When the price is dropping and social sentiment is negative, it is actually an easier environment for a large buyer to acquire size without moving the market against themselves. If a large fund tried to buy heavily during a period of euphoria and upward momentum, every purchase would push the price higher, making their average cost worse. But during a fear-driven sell-off, there is abundant supply from panicking retail traders, and a patient accumulator can build a significant position without the market reacting dramatically. The ETF structure has made institutional positioning more transparent in some ways. We can observe inflow and outflow data, and over any meaningful multi-week window, the direction of that data tells us something about the conviction of larger players. Short-term fluctuations are noise. The trend is signal. And the trend of institutional engagement with Bitcoin through regulated vehicles has been structurally upward, even if individual weeks show variation. On-chain data adds another layer. Metrics like the movement of long-dormant coins, exchange inflows and outflows, and the behavior of wallets holding large amounts of Bitcoin all provide clues about what experienced holders are doing. When long-term holders are not moving their coins to exchanges during a price dip, that is a signal of conviction. They are not trying to exit. When exchange inflows spike from newer wallets, that typically reflects short-term holders capitulating, selling their recently acquired positions at a loss. That capitulation is often a necessary part of a healthy market reset before the next leg upward. So what could actually happen from here? Let us walk through both scenarios honestly, because anyone who tells you they know exactly what Bitcoin will do next is either lying or fooling themselves. In the bullish scenario, Bitcoin holds its current demand zone convincingly. The daily candle closes stabilize, volume on down days decreases, suggesting sellers are exhausted. Then non-increasing volume, price begins to reclaim the levels it recently lost. Short sellers who positioned aggressively during the fear phase get squeezed as price rises, and their forced buying adds fuel to the upward move. If this pattern plays out, the panic selling we are seeing right now will, in retrospect, look like a textbook shakeout before continuation. Many cycles have followed exactly this structure. In the bearish scenario, the current demand zone fails to hold. Price closes decisively below key structural levels on meaningful volume. The market does not recover quickly. Instead, it enters a lower range, and the next meaningful support level becomes relevant. This scenario is more likely to unfold if macro conditions worsen materially, if there is a significant negative catalyst, such as a major regulatory development, a large exchange or lending platform experiencing stress, or a broader risk-off event in global markets. In this case, the appropriate response is not panic. It is patience and recalibration. Lower prices, if they occur, simply represent a different entry point for those with a medium to long-term perspective. The honest assessment is that neither scenario should cause a well-prepared trader to act irrationally. Both are manageable if you have a plan before either one materializes, which brings us to risk management. And I want to spend a moment here because this is where most traders lose money, not on their analysis, but on their position sizing and their emotional discipline. The single most important principle in volatile markets is that your position size should be small enough that you can hold it without emotional distress. If the size of your position is causing you to check the price every 30 minutes with your heart rate elevated, your position is too large for your current tolerance. That is not a character flaw. It is a risk management problem with a simple solution. Never put yourself in a position where a single move can destroy your account or force you to make decisions from a place of fear. If you enter a trade with a clearly defined invalidation level, meaning a price at which the reason for the trade no longer exists, and you size your position so that hitting that level represents a small, pre-accepted loss, then volatility becomes navigable. The traders who blow up their accounts are almost always the ones who sized in too heavily and had no plan for being wrong. Cash is also a position. There is no obligation to be in the market at all times. Sometimes the highest quality decision a trader can make is to wait. Wait for clarity. Wait for a level to hold or break decisively. Wait for a pattern to confirm. The market will always provide more opportunities. Chasing a move because you are afraid of missing out is one of the most expensive habits a trader can develop. Here is the insight I want to leave you with today. The traders who are panic selling right now are not irrational people. They are rational people operating without a framework. They feel fear, and they respond to it with the only tool they have, which is the exit button. The traders who will benefit from this moment are the ones who prepared before the fear arrived. They know their levels, they know their thesis, they know under what conditions they are wrong. And so, when the market gives them fear as its input, they can respond with logic as their output. Bitcoin has been through this pattern more times than most people realize. Aggressive sell-offs followed by confusion, followed by slow, almost invisible accumulation, followed by a move that leaves the panicked sellers wondering how they missed it again. The cycle is not a guarantee, but understanding it is what separates traders who grow their accounts over time from those who donate them to the market. If this breakdown helped you see the market more clearly, that is exactly what this channel is built for. Every week, we bring you the same level of structured, no-nonsense analysis because serious traders deserve serious content. If you want to be the trader who understands what is happening while everyone else is reacting to it, subscribe now and make sure you have notifications turned on. The next video could be the one that changes how you trade. Do not miss it.